You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
So for me, the supply side is something that's much more visible because it's out there. There's nowhere that it can come from. The demand pull is something a little bit harder to forecast. What's bullish about commodities is that it's not going to take a lot of demand pull for us to end up with the deficits that these guys are forecasting.
Welcome back to Mining Stock Education. I'm your host, Bill Powers. Happy New Year. It's 2023. And as we look ahead, I asked a commodity analyst and expert over at Exploration Insights, Joe Mazumdar, a frequent guest, to come back on the show and share his outlook for next year. So Joe, thanks for joining me again. First question, do you generally agree with Goldman Sach's analysis to where commodities are going to be probably the best performing asset this next year due to an underinvestment in the commodities?
Yeah, it's not usual that I take much out of a lot of these year in the future. What's going to happen, especially from Goldman, because they tend to be grand manipulators. So if they tell you one thing, they're doing the exact opposite. This one I do believe in because it's from the commodity people. So their idea is similar to my problem. Let's say if we focus in on copper or something like that, and this goes to a lot of commodities, that there's a lot of underinvestment, a lot of capital not being deployed, and that might be because of financing the risk. That might be because of capital escalation, that the numbers gotten a lot bigger. Might be because of geopolitical issues like in Peru and Chile that people don't want to develop. I know that in Zambia, First Quantum delayed a lot of their capital going into that country, which I think was multi-billion dollars to expand operations there from the mine to the actual smelter until the presidential elections. And so a lot of this capital has been deferred. And so that underinvestment, basically sets you up for a supply issue. So this is not a commodity supercycle demand pull issue like China, one single aspect. This is multiple issues, but a lot on the supply side, that there's underinvestment in a lot of commodities, such that we won't reach the kind of supply that people think, even for, let's say, a modest growth in demand. So I think that's hitting a lot of commodities, and so yeah, I have no problems with that in the medium to long term. The near term is the issue. If you get into it, and it could be good timing, is because the first half of the year, if China's reopening of COVID with post-COVID-19 restrictions, if that comes through, but it doesn't come out very well, the first quarter, first half could still be a little bit shaky for some commodities.
So is a supply-driven commodity supercycle, is that generally more powerful or more bullish than a demand-driven one? How do those compare historically?
This one for me is easier to see. It's just more. It's less opaque than trying to dig into the real estate market in China, or trying to figure out infrastructure issues in the States, or what the government's going to do with new policies. This one's a real sort of, hey, this project is not going to come in, or it's been delayed, or if this project is just been discovered, it'll take 18 years maybe for it to come into production. So that's just a timeline you could almost put your hat on. You could just say, okay, that is what it is. There's nothing going to come from Mars and bring us all this copper that right now we're not producing. So for me, the supply side is something that's much more visible because it's out there. There's nowhere that it can come from. The demand pull is something a little bit harder to forecast. What's bullish about commodities is that it's not going to take a lot of demand pull for us to end up with the deficits that these guys are forecasting. So there was no deficit forecast for this year, in copper, but now they're starting to build up these deficits because a lot of the capital has been deferred. A lot of the expansions that we thought that would be already underway have been deferred in places like Chile and Peru, which are the biggest producers of copper, and that's happening globally. A lot of places. I mean, with lithium, the Jadar deposit in Serbia, that got a big no in terms of permitting. I mean, that might be revisited. I don't know, but a change in the lithium price may not change that decision.
Joe, I saw an interesting exchange on social media recently to where one commentator who's bullish on a certain commodity pointed out the low inventories at the LME. And then another person responded and said, the low inventories, that's often overhyped. If you were involved in that conversation, what would you interject?
My background mostly on the market side is a lot on copper, and because of my background working as a market analyst for Phelps Dodge and Phoenix back in the early 2000s, is that back then inventories, whether it was the LME, the Shanghai Exchange, foreign exchange, and also the COMEX. But also at that time, Codelco was also building them at inventories because the copper price was like at 55 cents and they had to keep people employed. So they still kept producing copper, but they didn't sell it. So those four things were highly visible. We could see it. And so the stuff that was not visible was not very much. And that would be stuff held by consumers or producers because of, hey, you got to ship it to Japan and you're holding it at the port or something like that. What happened over the last 2 decades is because China has obviously become during that time in the 2000s the number one consumer of copper, but also has about 50% of the smelting capacity for copper. And, basically is a large consumer of the metal. A lot of the inventories are held there, but not on the Shanghai Exchange. It's held by other people, other companies and stuff like that. And that's not visible. So even though you're seeing very low inventories, there might be that the consumers might be holding a lot of inventory such that it doesn't matter if the exchange actually has a low inventory. What you really need to do is get an idea what the global inventories are, and then understand that by consumption to know how many weeks of inventory you have. What I would say is what you really want to watch, if you do want to watch the near term, is watch the cathode premiums, because the cathode premiums point to shortages in the market where people are willing to pay a premium on top of the price that they could get at the exchange to make sure that they get the copper. That's really what you want to watch.
And so are you bullish on copper in 2023?
Oh, yeah. I mean, the first half might still be an issue because what's potentially going to drive a turnaround in copper is China reopening, with no COVID-19 restrictions. The issue is China prepared for, the easing of restrictions? Because, when in Canada and the States, when, we eased restrictions, a majority of the population was vaccinated with the latest vaccines and had already 2 or 3 shots. That's not the case in China. And so, I've read stories about, them opening up, and now people are flying to places like Italy, and Italy are testing them, and they find out 50% of the people on the plane test positive for COVID. I don't know how that's going to work out. And that might result in more shutdowns, lockdowns, depending on if they go back to the old policy. So I'm not sure if that's going to happen. But right now, because they took the genie out of the bottle with respect to taking off the restrictions, it's going to be hard for them to go back to the same level of restrictions in terms of shutting down entire cities. But that might be a 3 to 6 month issue. But certainly in the second half, I can see that the demand for copper picking up. But since my view on copper is more medium to long term, I'm going to be picking up, what I think are good plays, with that layer of the issue of market segmentation, with that issue about who can get permitted and not permitted, and the water issues that we have in a lot of places in the Americas, and social license to operate into my thesis for acquiring any company's shares.
So, Joe, with the analysis of copper you just laid out, would you agree with those that say it's easy to predict where a commodity is going to go in the medium and long term, but it can be quite difficult in the short term? Is that kind of what you articulated right there with the copper market?
Yeah, I mean, this is kind of funny because I would have said that because one of my bosses was the senior vice president of sales for Phelps Dodge, Art Mealy, and he used to drum that into my head. He said, "I can tell you what the price is, copper is going to be in 10 years, but I can't tell you what it's going to be tomorrow." And the issue is that economics tells you, for good or bad, is copper's a commodity where price equals marginal cost. So then if you can work out what the marginal cost is for production into the future, then you go, eventually the copper price will revert to this because that's the incentive for people to keep producing. But in the near term, there's so much speculation that'll change, the copper price that you can't predict exactly what it's going to be. So what I look at in terms of the difference between what people are saying, like, and that's the liquidity in the copper market. They're saying that copper cathode is worth this much. But even if it's a low price, the industry is telling me with M&A that, hey, it's worth a lot more because these guys are into consolidation. So if you see consolidation, that's a pretty good precursor for a move in the market.
Excellent advice. What about the precious metals? You follow the gold and silver markets. They've had a good 2 months. Do you think that continues throughout this year?
So if we look at that, a lot of that in the last quarter was basically driven by the dollar. So the dollar was down about 7 to 8% in the fourth quarter, and gold was up 9%. So I think a lot of that is dollar related. But if you look at Pierre Lassonde when he was with Newmont, when I worked there, he used to say that, hey, when gold is up in multiple currencies, that's a bull market for gold. Really, the only currency that gold didn't do very well in was the US dollar. A lot of other currencies it did really well in because of the issues that we've had globally, and probably because of the issues of the strength of the US dollar. Because people are sort of forecasting now that inflation is easing in the States, that we'll still get incremental increases in rates, but potentially not escalating quantums, and eventually it'll come down. But that doesn't mean there's going to be a rate cut. But the idea that the rates will come down and the tightening policy will lessen, it's almost like the second derivative. People are taking a punt that that being a negative impact on the dollar, and hence the impact on the dollar in the last quarter. But if something else happens in the Ukraine or somewhere else, then you can see potentially a little bit more volatility in the US dollar in the first and second quarter. But most of the pundits are talking about the US dollar weakness into the next year. And if that's the case, that would be good for the US dollar denominated gold price and potentially for other US denominated commodities.
As you mentioned, you have a lot of experience as an analyst working with Phelps Dodge. What was your worst macro commodity call, and why did you get it wrong, if you don't mind sharing?
Okay. Well, I mean, if we go back there, what we used to do, so I used to have this model of demand and supply where we use industrial production to model demand. And that was back in, let's say, 2002, 3. So copper started off being at about 55 cents, and we had shut down a lot of production in the Southwest U.S. Codelco shut down production, but like I said, they were building up inventories. BHP took production offline. And so when it was growing from 55 cents to $1 and eventually $2, what we got wrong perpetually was China. We did not predict China's growth, which was double digits. It was like 15 to 20% when we were saying it would be 5 to 7. And whatever China did made up for our wrong predictions or forecasts for Europe and somewhat Japan and that. So China just offset everything. And then every year we would get that wrong because we couldn't think that they would actually grow that fast. So that was probably the biggest macro call. Not saying that was just my call in itself. It was just how it worked out that I was involved in. as recently as now, over the last couple of years, my macro calls, maybe not a call, but more so ignorance of, a lack of sort of knowledge of, was sort of staying away from smaller commodity markets like tin and 2 years ago, and lithium now. And the problem is that it's like what we talked about off air. I mean, lithium's growing in terms of the market, but there's no way I would have predicted that the spodumene price would have went up so much. Just because that spodumene, I mean, what miners are doing to the spodumene, taking it from 1 to 1.5% to 6% in terms of concentrate, is really worth that much in value. That really blew me away in terms of how much, and that was just because of a tight market.
What about ESG, how it impacts the miners? Do you think, I've heard the two sides of this, to where ESG, it's going to attract more funds to go into the metals and specific miners, but I've also heard it argued, no, the ESG requirements are becoming so burdensome and restrictive and making permitting in some cases difficult that it's actually going to make it more difficult for the miners. What would you have to share here?
Well, I would say like we've got ESG. So we got the environmental part, if we want to focus in on that. Then we got the social part, and then we got governance. So mostly when people talk about ESG, I guess they're focusing more on the E. Like, because social issues, social license to operate, let's say, that's been an issue that miners have had to manage for decades. So that's nothing new for them. Governance with respect to the companies, that's something new when we're seeing more diversified boards and management teams, which is good. And that's been something people have been doing. I know that's been something we've had in Phelps Dodge when I first worked there in the 2000s, mostly from the countries that we were working in, with Latinos and people like that coming into management. The environmental part is another bigger issue, because there we had no problems with diesel trucks. We had no problems if we were getting our power from a coal mine. Those were never an issue. Now that's being more of an issue to say, hey, I'll only invest in your copper mine, which is a critical mineral for some countries, and say, and that's one thing I want exposure to. But if you've got carbon footprint, if your carbon footprint's whatever, then I can't invest in it. And so now what we're seeing is that before, like whatever, 10, 20 years ago, we would focus in on the cash cost. Here's the cash cost curve. Here's my percentile. I'm in the lower quartile. So, hey, I'm a good project, invest in me. Now it's sort of like, okay, what's your cost profile? I'm at P50. Okay, but what's your carbon footprint? And then you go, hey, I'm at the bottom. I'm in the lower quartile. Well, that I can invest in. So that could trump some of the economics of some projects, especially in good jurisdictions where people can say, hey, it's a good jurisdiction. The permits are in, blah 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 blah, and they have a low ESG footprint. Meaning that they've got hydropower, wind, or whatever that they've got, and they also use electric trucks, so the less diesel footprint. But that's really infrastructure driven, because for someone to have the electrification, infrastructurally, they got to be really close to grid power, because no one's building 1,000 kilometer power lines. So, and then where are they getting the power from? So if it's just coming from coal, that's okay if you're in China, because they care less about it. But if you're a Western company, that could kill you in terms of getting that investment. So I can see both sides. But if you have everything going for you, that is a boon in this current market.
Okay. So you filter that in. That's one of the key filters you're going to use when you're doing your due diligence then, what you just described.
Yeah, because in the end, our liquidity event is a takeout. And so when we're looking for a takeout, if it's a Western company, because now we have that imposition that Chinese companies can't be the M&A suitor anymore, especially in Canada and probably in the States, but probably they're not saying it as loudly, but I'm sure that's probably an issue, is that now we have to deal with their shareholders and what they want. And if you can prove that, hey, this will actually not only, keep your cost curve the same, let's say, but lower your carbon footprint per ton of copper produced or per ton of gold ounce produced, then that might be something that they want. because their carbon footprint is so big in their other operations. And so that's definitely something that people have to take account of.
What about where you're putting your money in terms of the producers, developers, explorers? Can you share where you're seeing value right now?
Well, the thing is that if we talk about, the issue with development and, capital deployed and not deployed and, the potential for, underinvestment, that's what we're sitting at right now. And retail does not want to touch anything that's a development project because of capital escalation, that we've seen in, these marginal gold projects in Northern Ontario and that, and elsewhere. But the thing is that that's the same reason that we think commodities are going up is because we're not investing in these development plays. So
it's about getting the timing right, though, right? As the investor.
Yeah, because if you pick the one that's going to get acquired, then that's fine. But if you pick the one that's going to produce their own and then it's going to take them a couple of years before acquired, then you got to take that into consideration because that's definitely something that could happen. Because some people might want to wait until it's into production and they've passed by all the hurdles. But what we're seeing right now in terms of development plays for critical minerals, it's a different world than development projects for gold. In that, governments, private equity, and some other firms are willing to give them the money if it gives them more exposure to critical minerals. That's not the case for gold and silver, So if you are in the development space and you're worried about access to capital, then I would focus more on the critical mineral developers. So exploration, I'm fine with anything in terms of commodities, but most of what I've been purchasing over the last year has been a switch from a lot of precious to copper. And that's exploration, that's production, and that's sort of pseudo development, like advanced exploration, because I know copper is an issue. And if I could find one that actually makes cathode even better, because then it doesn't have to be sent to a smelter. And most of those smelters, like I said, are in China. So that's one thing that I've been sort of doing. The other thing is, thankfully, I did see the issue about margin compression with gold companies earlier this year, and so I'd gotten out of precious metal production and then sort of moving into more of the royalty space and more royalty generators and that sort of thing.
Joe, on the gold mining, I've had more than one person from the sector tell me that they think gold mining is going to be hurt by the ESG movement, in that that could be a potential hindrance for developing gold mines in the future. Do you agree with that, by the way?
Yeah, so ESG, in terms of the carbon footprint, a lot of the carbon footprint for gold is actually less than other commodities because they don't have to send it to a smelter. And so that next level of scope in terms of shipping, freight, and then where does the power come from that smelter to produce the copper? That impact does not impact gold. So the carbon footprint overall, if it's like a project that's close to a grid and stuff like that, is actually lower than especially for a nickel project. But the issue is that the nickel and the copper and these other commodities are used in this carbon neutral sort of society that we need these metals. And so there's a sort of a theoretical offset there that this is what you need. But that gold doesn't fit into that picture. And so in terms of ESG, you're not going to get that government funding for a gold development play. You're not going to get that equity that's all ESG focused equity fund right now going into a gold play. And so your access to capital is less than for that copper play, I would say, even though your carbon footprint might be less. The problem is that your carbon footprint is less for a product that's not involved in the carbon neutral society.
Okay, so I have a follow-up question. If what we just laid out there causes less gold production because of this, does that affect the price of gold at all? Because I've also had guests on the show say that the price of gold is not affected by supply and demand the way other commodities are. What are your thoughts here?
Absolutely, it's not. It's not a price equals marginal cost commodity. It's more of a speculative commodity. That's why people are looking at everything that's happening in the economy. So we're looking at all these macros, and then gold's sort of like the last thing that comes out of the toothpaste and says, you know what? This is my barometer on what's happening in the world. And people want it. The thing is that when they can't trust their currency, they can't trust their government, or, they want gold. They want something to hold on to because they don't trust anything. And that's the same issue that people thought that they could get from cryptocurrency, which has not been a solution. So if anything, people have gone back to gold thinking, screw cryptocurrency, I'm going to stick to my gold. And so there is that demand for gold for that, but it's not driven by, hey, it costs you $1,600 to produce gold right now. Well, if I'm looking for that incremental ounce, yeah, I'm going to have to pay that $1,600 or $1,700. But in terms of, a direct relationship, I'm not sure about, because there's so much gold above ground that's been held that's not consumed. Like copper, it is consumed. These other commodities are consumed. We do have some scrap from copper, but a lot of these commodities, it's hard to get that out again. Gold, it's still there. There's a lot of gold above surface, but whether you want it in your hands or not, that's where you really have to pay. So yeah, I agree with both camps in terms of gold being different. Silver is sort of like somewhere in between. A base metal and a precious metal, because it is a mineral that can be used in the carbon neutral society with respect to solar panels and that. So, but gold's not there yet.
What about the Canadian regulators? What are your thoughts on them allowing small cap companies to raise between $5 and $10 million with no prospectus and no hold on the stock? What do you think about this?
I like what they do in Australia. I like the fact that they don't have the hold, and all it's doing for me is basically locking in a price, and I have a certain allotment that I don't have to worry about the price going up as I'm buying. So for me, I like that. But I would warn people that I'm not sure how this impacts flow through, because the more disincentivized shareholders you have that are just in there for something else besides the management, besides the asset, besides all those things you're buying the stock for, the more reason they'll sell. And if it's a tax incentive, there's no reason for them to wait 4 months to sell it. Now they can sell it right away. And so you have to be a little bit more conscious of the people that company has included in that private placement.
And then charity flow through would be a difference, though. If it's charity flow through, maybe it's okay.
Yeah, charity flow through is very important in the sense that you have a back end buyer that will take that charity flow through, and then you have a hard dollar price. And as long as the market is valuing it on the hard dollar price, the shares don't balloon out to $1.40 and then come back to $1. And everybody knows the real hard dollar price is $1. That's fine. And I think. For me, I like it more because I do like the Australian model a lot.
Okay, Joe, I know you got to go, but before you go, one stock pick, are you able to share with us?
Yeah, I mean, I just added a prospect generator. So I had a prospect generator in Australia that I liked. They made a deal with a major company on a farm-in, but I actually liked the farm-in that the major did with another company, and that was Headwater Gold, HWG, on the venture. It's a prospect generator. It's got good management, and they're based out of Reno, Nevada, and most of their assets are in the Great Basin of the Western U.S. And they have a decent deal with Newcrest and a lot of a funded catalyst coming up, which is very important right now in terms of access to capital for people, and also the management fees that they get to operate those that budget for over the next 12 months pays for their G&A. So they really only need to raise for their 100% assets. So if they do, they will be opportunistic with respect to their share price. They're not under a gun to raise money coming into the new year, which is companies I would definitely like to avoid.
So in terms of the junior sector, that's a more safe investment as a prospect generator. This isn't a hit or miss exploration play.
Yeah, no, they've got a lot of irons in the fire, and how they fund them. 3 or 4 projects are already funded for a certain amount of time by Newcrest. and then it will be results driven. And that's basically geological risk, and I'm okay with that because that's why we're in it.
Yep. And I think your partner, Brent, says you'd rather take geological risk than financing risk, right? If I recall him saying that.
Because if you want that, whatever 3-bagger or whatever, it's going to be the drill bit that gives it to you because that's an unknown and that's why you're drilling. But you don't want to find out, oh, hey, management did something else, or hey, jurisdictionally, we've got a security issue or something like that you should have seen before that happened. That's what I tend to like. I'm okay with the geological risk.
Excellent. All right. Joe's website is explorationinsights.com. There's a lot of educational materials you can find there. And if you're interested in his paid for letter, you can also find information there. Joe, really appreciate the check-in, and I'll reach out to you in about 3 months to bring you back on the show.
Great. Thanks very much, Bill. Happy New Year.
Happy New Year.